Hey, so welcome to video number 6 in the series. I'm going to start talking about position sizing, and this is something that really changed the way I trade when I started to wrap my head around it. And there's a lot of reasons to think about it, which is why I'm actually doing this video in 2 parts. I didn't want to have to rush through anything. Aside from the risk reward ratio and the win percentage we talked about in the last, not the last video, but video number 4. I think this is the third element that you need to understand to have good money management. So let's talk about different strategies with position size. So there's a lot of names for it, but some people call it fixed position and relative position, or fixed and variable. Some people call it equal dollar and equal risk. Sorry for the handwriting. I've heard it called fixed fractional strategy or something. There's lots of ways to call it, but pretty much what it means is that one is you always bet the same amount of money, and one is you always risk the same amount of money. So to get into the differences, so let's say you always trade $500. That's how much you buy every time. And you don't kind of adjust it for how much you're willing to lose per trade or how much you want to win per trade. You just always go in $500. So to go back to that like inverse head and shoulders pattern we were talking about, this would be an example where you buy here and you say, okay, I'm going to sell at the bottom of the shoulder like we talked about, because that tends to be what invalidates that pattern, or it's supposed to be. And so you set your stop loss there. Now the problem is that distance could be anything. It could be 2%, it could be 5%, it could be 10%. So what's happening is every trade you're going to lose a different amount of money. You're risking a different amount of money. And that's not necessarily good if you're trying to be consistent. You want to control the amount you risk for every trade. So the other side of the coin, the equal risk, or the relative position size, would be if you have $1,000 account and you always want to risk 2% of it, that would mean that you always want to risk $20. So then finding where to put your stop loss is easy. If you put your entire $1,000, that would mean you have to put your stop loss 2% away from your entry, right? Price goes down 2% and you put in $1,000, you're going to lose $20, right? So let's say you have a $1,000 account, but you only like to bet 50% of your account per trade. So what would happen there is you're trading with $500, and if you want to lose that same $20, now it means that if you get in, you would put your stop loss 4% below price, right? Because 4% of $500, just in case you don't believe me, is still $20. So you're risking the same, and that wouldn't matter if you did 10% of your account, meaning you trade with $100 every trade. That means you could put your stop loss 10% below and on. Now, there's a problem with that. In this previous example, when we talked about the inverse head and shoulders, and again, I'm not condoning trading this system or anything. This is just, I think it serves as a good example. If the idea is to sell here, well, if you're only going for, let's say that's a 10% drop, and you're only going down 2% every time because you're trying to get the same risk every time, that's going to be like way up here. You're not giving it a chance to invalidate or whatever. And if this is only a 2% drop and you're doing this thing where you're betting $500 per trade, so 50%, so your stop loss is 4% away, and this is a 2% drop to here, you're putting your stop loss down here, which is way too low. Like, you should have gotten out where it got invalidated, right? And so what happens is this isn't perfect because you're always losing different amounts, but this also isn't perfect because you're kind of just always trading for the same risk. You're not trading based on the charts. You're not trading based on like the patterns. And that's what you're trying to do as a trader, right? You're trying to find patterns. That's what you believe. You believe there are patterns in the market. You believe that people who are participating in the market will behave in certain patterns. But those people don't care about your risk reward. The market doesn't care about your numbers, So what you have to do is develop sort of a combination of those two. And so let's give another example. We'll call this number 3, another inverse head and shoulders. And let's say you have a $1,000 account again. So the first thing you would do is you would say, okay, what is the distance between here and here, right? That's the amount I want to trade. And you would say, let's say that's 5%, right? So you say, that's where I want to get out because that's what the market's telling me. At that point, I believe I'm wrong, whatever. So then you have to say, okay, well, I only want to risk 2% of my account, which is $20, right? So then you have to say, okay, how much money do I have to put in so that if I get a 5% drop, it equals $20? The formula for that is, because you're trying to say $20 equals 5% of what? And the formula for that is you just do 20 divided by 5%. So 20 divided by 5% equals $400. So in this case, your position size would be $400. So that, here I could prove it to you. If you do $400 and the price goes down 5%, it's $20. You lost that same amount, right? And you can try with different amounts. If this goes down 10%, and you say, okay, I want to risk $20. You do the same formula, but now you change this to 10% instead of 5. Let's do that again. $20 is 10% of what? Divided by 10% is $200. So you would put $200 in, and then if the price goes down 10%, you lose your same risk every time. So what's happening here is you're kind of getting the best of both worlds. You get to trade with the chart, and you get to risk the same amount of money every time. But like most things in trading, this is more difficult to do than this, and people don't want to do that. So a lot of people end up doing one of these two things. But this requires, you could set up a formula in Excel or a spreadsheet and just kind of like punch in numbers really quick, and it'll tell you your position size. It normally won't be exactly $400 or whatever. It might be some weird amount. You set your account size, you set how much you want to risk per trade, etc. So the first thing that you might notice about this is that if you're used to trading like, little 2% drops, 2% upswings, 1% upswings down, all of a sudden you can start trading, 10% swings down. Normally you're trading 2% here and there. Now you can go for a bigger long-term trade, a swing trade, and you might be scared, being like, whoa, I'm not cool with losing 10%. But if you size your position the way you should, this is going to give you the same amount of risk. Both instances end up losing $20. So it sort of expands your horizon with what size of trades you can take. You could take tiny little trades. You can say, I'm just going to trade for little tiny 0.5% moves. And if you're risking the same amount, you can actually still make the same amount of money as you would with bigger swings. The other thing that I think is really interesting about this is, let's just draw another inverse head and shoulders. Let's say you start to notice, so normally your target is, they say you should be the height of the head. So let's say that's, 12% or something. So you're going to trade hoping that it goes up here 12%. And normally the stop loss here, let's just say it's 6%. Let's say that distance is 6%. And you start to realize, you know what? Usually when it gets halfway down the shoulder, just like here, at that point it's already too late. It always ends up going down. So you say, screw it, I'm going to start putting my stop loss there. So in this case, it would be a 3% drop, right? You cut it in half. Well, what'll happen is, now if you calculate how big your position size should be, so that same account, right? You want to risk $20, and you're looking for what position size would equal 3% loss, right? We did that same thing. Let's just do it over here. 20 divided by 3%, right? 20 divided by 3% equals $666. The devil's number. So going back to where you thought the price might drop 6%, at that point, your position size would have been 20 divided by 6%. It would have been $333. But your new position with the 3% drop is $666. But as we saw, your actual risk amount is the same, right? $333 dropping 6% equals $20. $666 dropping 3% equals $20. So your risk is exactly the same. But here's the difference. You're still going for the same target. right? You're still going for the same take profit level, that size of the head. So what'll happen is, before you were making 333 times 12%, you were making, 39.9, whatever, so like $40 a trade. Now you're betting 666 times 12%, and you're making about $80 per trade. So you're risking the same exact amount of money, but your reward just increased by double because you're moving your stop loss tighter. And we'll talk about that a little more in another video. It's called your MAE, which is adjusting your stop loss based on your experience. If you start to see that your trades don't you could get stopped out here and you would still win the same amount of trades, you can start tightening your stop, but your take profits can stay in the same place, and therefore you can increase your position size, which means you can increase your risk reward. So I think this should be enough to convince you that you should trade with this sort of position sizing. I'm going to do another video after this to give you even more reasons, but I think it really changed the game for me. It opened up the kinds of trades I looked for. Like, I stopped looking for, I'm only looking for trades where I can get 2%, 5%, 10%. It was like, I could trade any size. I'm just going to adjust my position depending on what I can get. So it's really is a game changer. I hope you consider doing it, and I'll see you in the next video.